In this video, we will talk about the different ways that a real estate investment can protect you against inflation. Inflation is a general increase in the price level of goods and services over time, resulting in a decrease in the purchasing power of money. In other words, inflation means that a given amount of money can buy less goods and services than it could in the past. Inflation can be caused by a variety of factors, including an increase in the money supply, increased demand for goods and services, or a decrease in the supply of goods and services. Inflation can have both positive and negative effects on an economy. Some level of inflation is considered normal and healthy, as it encourages spending and investment. However, high or unstable inflation can have negative consequences, such as reduced consumer purchasing power, increased borrowing costs, and reduced economic growth. Inflation reduces the purchasing power of money over time, which means that the same amount of money will buy fewer goods and services. This can impact investment returns, particularly for fixed income investments, such as bonds or savings accounts, where the returns may not keep pace with inflation. Moreover, inflation often leads to an increase in interest rates, as central banks seek to control inflation by tightening monetary policy. Higher interest rates can negatively impact investments such as bonds, as the value of existing bonds decreases when new bonds with higher interest rates are issued. However, such is not the case with regard to real estate investments. Real estate can protect you against inflation in several ways. 1. Appreciation. Real estate has historically appreciated over time, meaning that its value increases over time. As inflation increases, the value of real estate also tends to increase, thereby protecting the investor against the loss of purchasing power. 2. Rental income. Real estate can generate rental income, which can increase over time due to inflation. This means that as inflation increases, so too can the rental income from the property, providing an inflation hedge. 3. Leverage. Real estate can be purchased using leverage. In an inflationary environment, the value of the debt decreases in real terms as the value of the currency decreases. This means that the investor is effectively paying back the debt with cheaper dollars, providing a natural hedge against inflation. 4. Real estate is a tangible asset, meaning that it has physical substance and can be touched, seen, and used. In an inflationary environment, tangible assets tend to hold their value better than financial assets because they are not subject to the same market fluctuations. All in all, real estate can be a good hedge against inflation because it tends to appreciate over time, generates rental income, can be purchased with leverage, and is a tangible asset. However, it is important to remember that real estate investment comes with risks, such as changes in the economy and local real estate market conditions, so it is important to do thorough research and consult with a financial advisor before making any investment decisions. So, there you have it. Hopefully, you have learned something about how real estate investments can minimize the adverse effects of inflation. If you have questions or comments, please leave them down below. Thank you for watching. And please don't forget to subscribe.